The Mortgage Geek is back and here to give us all the goods on our low mortgage rates. Please welcome the Vice President of Cornerstone Mortgage Group, Sean Cahan.
There he is, Mortgage Geek, back in the house.
All right.
What's up, brother?
It's been a while.
It's been a minute. Glad we get the chance to wrap. I always like to pick your brain, see what's going on. I know we've talked in the past, the recent past, about how you have unloaded some of your own personal real estate holdings here.
Absolutely.
You felt the market might be at maybe a cyclical peak. But the drum that everyone keeps beating is that, but interest rates are so low. But interest rates are so low. But with interest rates this low, that's how all the conversations start. So I think it's important to have that conversation every once in a while and go, wait a minute, are interest rates really still low? And why are they low? And what would cause them not to be anymore? Is there any kind of warning signs that we could give out to people? So first of all, rates are still very low. When we say low, we mean like sub 4%.
Absolutely, yeah. I mean, it's crazy.
Conventional, FHA, VA.
It's like the 10-year kind of goes up and down and really nothing's really attached to it again, you know? It's very odd. It was down to like 1.3, 2, and then now it's back up to like 1.77. It would reach like 1.8, and the interest rates kind of are like just right in the middle there in the, you know, mid to high threes. Just kind of, I think that the banks just did not come all the way back down like where they did in 2012. Remember, it was like 3%.
Right.
So remember, they were hovering around like 3.5, and everyone's like, well, shouldn't the interest rates be lower? I'm like, how much lower, right? To match 2013, the banks just don't need to go that low. But at the same time, I mean, our country needs to do something, right? Or we're I think, gonna go into possible hyperinflation, which would not be fun.
Yeah, I'm worried about that too.
Yeah.
Because if you think about it, I mean, like our grandparents, when they made money and wanted to save it, they bought CDs and they made like 15% on their money in CDs. Now, you know, it takes a lot more risk to make a smaller amount of money. I saw someone, a guy who sells like multi-unit apartments and stuff like that. He posted one on Facebook for sale. It's like a fourplex in PB or something like that. And the cap was like 4.54%.
Crazy.
It's like a $1-point-something million pad. And I'm thinking, wow, is someone going to get excited about that 4.54%? Because they have to put a lot out there.
Yeah.
I mean, a lot of money down.
To really make no actual dollar return.
Yeah. So I look at stuff like that and I go, wow, are we creating a culture where we have to take on that much risk in order to get that little of a return? And what does that cause? Well, historically, you said the I word, you know, inflation.
Yeah.
That's what's going to happen. You're going to see inflation. I mean, what would be nice is a little deflation. Deflation would be really nice.
I'm like halfway through the book Aftershock right now, and it's scary. Like, to know how much money's being printed to keep our interest rates down, what that actually is doing, right? So it's like back in like the 80s, they called our economy like the bubble economy. We created bubbles now, and that's why all these bubbles are bursting. Like, they get overinflated and then they burst and then they go down, and then we kind of, you know, recover on like false pretenses, right? And like the stock market at 18,000, where did that come from?
Yeah, how could it be near an all-time high? I mean, it doesn't seem like we're at all-time. I mean, with all the layoffs, just from the companies that are here in San Diego that people are paying attention to, like Sony and Qualcomm, you know, that have, you know, thousands of people that they're laying off. Thousands and thousands. Because at the end of the day, I think what a lot of people fail to realize about those layoffs is that they're actually good for the company's balance sheet.
Yeah, they're extremely good.
They're good. I mean, but it's also a sign that sales aren't there, because the company's looking to go, well, we need to make this much per share in order for our stock price to be here.
Keep our stock prices.
That's how they look at it. So if they're not bringing in the revenue, then they just go to the other side of the thing and go, all right, well, let's get rid of expenses, and then we'll make that much money.
Keep their projections almost the same.
Yeah. So we keep the, you know, the analyst projections, you know, approximately where they're going to be. So in other words, the stock price will not necessarily go down when layoffs get announced. It might go up. They might just inject confidence, like, oh yeah, these guys are paying attention to what's going on. They just saw they were going to miss, and they said, we're going to fix it.
Okay.
So that's how the stock market is not necessarily the right indicator for us to be looking at.
No. It's I don't know really what indicator to look at, because every
That's
time
the
that
question.
something kind of starts to come out, right? Oh, the 10 years going down and Brexit. Nothing.
Yeah.
Okay, now Brexit is not a major topic. I mean, I haven't heard anything
gone.
about it, right?
Yeah.
And nothing really changed.
The
So-
only people who covered it were me, you, and Max,
Yeah.
and all of the media. We brought Max Folkers on. We talked about it. That's it. No one else talked about it. They're like, all right, Brexit, done.
Now people's excuses are, the election. We're going to wait to see what's going to happen with the election. We're
Yep.
going to wait to see what happens after the election. Oh, the interest rates are going to be increasing, the Fed rate increasing in December, right? That's pretty much like, I feel that that's a guaranteed move. They haven't raised it since last December. They're probably going to raise it again in December. What does that do with 30-year fixed rates? What did it do last time? 30-year fixed rates went down after they raised the Fed rate, right? So
because it's a confidence thing, right? So the
Yeah.
mortgage rates are based on mortgage bond sales.
correct.
And when you can't get any return at the bank, when there's no return to get anywhere, big money, and I'm talking serious cake, like the kind of people who are moving tens of millions, hundreds of millions of dollars a day, they're looking at, they need to win. They can't afford a loss. So they'll take your mortgage bond at 3%.
All day.
All day, because hey, I got $100 million to put in there. I'm going to still come out with a nice chunk of money.
Yep.
Even though my percentage return isn't that great. So they'll take that all day long. And I think the raising of the rates last time provided a piece of confidence in the marketplace. Was like, okay,
Something's going positive.
yeah, something must be
Yeah,
happening.
the economy's doing better.
Yes.
Yeah,
So
exactly.
it's weird that the dynamic between what people think the lowering or raising of interest rates means versus how it actually plays out in the economy. Because, like you said, if they did raise rates again in December, which a lot of people think they will, I think that would have potentially another positive effect on everything. And it may be psychosomatic, it may be placebo effect, maybe it isn't that good and they're just doing that to bluff, but it could work.
I hope it does. I think it's going to get a lot of people off the fence. There's so many people on the fence right now, and they're like, "Oh my gosh, interest rates are so low." I'm like,
To buy
okay,
homes?
Great. Sell your house and go buy another one, or get some action out there. I think that some of the valuation are increasing right now, and people are needing the lower interest rates just because there's really nothing on the market. I mean, we have so many pre-approved buyers right now that just are working. I have one lady that she actually purchased a home. So we wrote like 5 offers, and this one they're going back and forth back in February. Okay? February, almost 8 months ago. She bought another house. Her house has now increased $150,000. She is selling that house, and she made an offer on the home that she did back in February because the seller was like, "No, my house is worth more." Now she's like willing to actually pay more because she made $150,000 in 8 months on this other house.
Oh my
This
goodness.
is crazy.
That is crazy. I mean, that stuff scares me.
You're right.
When I see stuff like that, it scares me.
It's almost what we were doing back in like 2006,
I
2005,
know.
2006. Like, hey, we were just increasing, and people were just taking out, or, "Oh my gosh, my house went up $50,000. I'm going to sell and I'm going to go buy something else."
Well,
And I think that the interest rates are actually allowing people to do that. What would happen if we raised our interest rates 0.5% or 0.75%?
Well,
We'd probably see like a serious slowdown
yeah.
for
Well,
a little bit.
that happened a couple years ago. Remember that 1 week?
2013?
Yeah.
August.
Yeah, that it just went up a point
Yep.
in a week. And that really caused a lot of the action. It was so abrupt. It caused a lot of the action to stop, but it caused a lot of people to really pull the trigger. They really had no choice. So I don't know what would cause it to, what would cause this to change right now. But when I hear about, that much money being made in that short a period of time, everyone always says, well, yeah, but people are fully qualified now to buy homes, whereas back then they weren't. I'm not saying 2008 is going to happen again.
No,
that
I
could
don't
never
think-
happen.
I don't think so either.
But I still think people are able to qualify for too much house too easily. That I will say.
Yeah.
So that's kind of the same thing as before. Not as drastic, but it's the same idea of buying too much house. It's a fragile situation.
So 1,800 exceptions last year at a specific mortgage bank was requested. 1,800 exceptions for debt to income ratio.
Okay.
1,500 of them were approved to go above QM DTI, 47 to 49%. 1,500. So it's happening.
Yeah, that's what I mean.
And at these low rates. So think about something that's actually like 0.5% higher on $1 million, right? That 49% is now in the 50s. They're not going to get the exceptions. Or are banks going to make the exceptions for the 50%?
That's the big question.
Are they going to increase it? Because QM 2014, right, we're not supposed to go about 43.
But it's
Now it's 45.
Yeah. Mm-hmm.
Now it's 47. Now what? 75% or more were just granted up to 49. See, so it's kind of like it's trending that way. So it's fun to like look at the actual bank side.
Well, yeah, and
See those things.
Of course, because it's just always that's how we do. You know, that's how Wall Street is. That's how big banks think. I mean, it's always stretching it just a little bit further. Oh well, we're safe here, and they just kind of taking that further step towards the cliff. I know, huh? Well, it's still safe here.
Yeah,
still safe here. Still safe.
But
here.
is it really safe? So here's and I'm just throwing this out there, right? Before, and we've talked about this back in for a very long time, it was like, if you missed a mortgage payment, you did not tell everybody you missed a mortgage payment,
right.
Okay? Until like 2008, 2009. Then it was like, I've missed 17 years of mortgage payments. And everyone's like, wow, giving you high fives and patting your back. So it was like a different era. Somebody is at a 50% debt to income ratio, already experienced missing mortgage payments, kind of letting their house go. I don't think that the whole bubble is going to burst and we're going to go down like 40% just because there's a lot of money and there's a lot of people qualifying for homes. But what happens with that buyer at a 50% DTI and their value goes down maybe like $50,000 or $100,000? They've already experienced that there's no negative side effect to missing a mortgage payment or to not making a mortgage payment. So are we quicker to act on that?
I think they'll default very readily.
Easy.
I think they'll default easily and say, oh, I need a loan modification. I need this, I need that. And I think the servicers are more prepared to handle those things, more prepared and ready to do short sales.
Yeah.
There are rules in place now that they can't run the foreclosure alongside the modification, which is nice. Mm-hmm. So I think it will be a little bit cleaner, and just from a quantity perspective, there's less of that's going to happen. So I don't know, man. We'll see. Crazy times.
Yes, it is.
Crazy times, but nothing to say that rates should go up anytime soon. In fact, based on what we expect to happen and what has happened in the past, when that happens, rates could go down a little.
Yeah.
But we certainly don't expect them to go up.
I would say if you're in the market of refinancing or somewhat on the fence, and don't try to time the market perfectly, because you will never time the market perfectly. If it makes sense, you're saving money, you're not paying a bunch of closing costs, do it. There should be nothing holding you back actually from making those corrections. Especially, you want to refinance. If you are going to refinance, you want to do it as close as you can to the last refinance.
Right.
So that you're not just re-amortizing your loan just to save money, where a lot of people are making that mistake, right?
Yeah.
Actually look at the amount of interest that you're saving and the amount of closing costs, not what I'm going to save $100 out of my pocket because I'm re-amortizing.
Right. Yeah.
Right?
No, and a lot of people do that.
Yeah.
Every year.
They're like 7 years in, and oh my gosh, I'm going to save $200. Well, it's because you've already paid 7 years.
Yeah.
Right.
So you still have 29 years and 2 months left on this thing. We don't want to see that. We want to see people pay their homes off. So be smart about it. Great advice, Sean. Appreciate your time today, man. Thanks a lot for coming.
Cool.
Stick around for more Smarter San Diego TV, where we guarantee to make you smarter than everyone else, commercial free.